in short, the markets they're not behaving any differently than they normally do in periods of uncertainty. Markets do not like uncertainty. Always remember that. Speaking of those markets, let's see how they fared this past week. You had the Dow Jones Industrial Average all the way down to 16,102. That was a 541 point decline. The question now is, what's going to happen first? The Dow Jones Industrial Average hitting 15,000 or 17,000? Forget about 18,000 for a while, even though we were just there a couple of weeks ago. Now the question is, what's going to come first? I know you never thought we'd talk about a Dow Jones Industrial Average, at least thinking about 15,000. Well, here we are, 2,000 points less than 18,000. And I figured I think we might get to the 15,000 before we'll get to 17,000. I think certainly before we get to 18,000. But you never know. The S&P 500 didn't fare a whole lot better. It closed at 1921. It was off 67 points. The tech-heavy NASDAQ closed down as well, 145 points to finish at 4683. That's right, 4683. I remember just a few weeks ago, a month ago or so, it was at 5,200, an all-time high. And that was big news. Now here we are at 4683. But technology has a way to lead markets, so that could be 5,000 in the not-too-distant future. But we'll have to wait and see again. The Dow Jones Transportation Average down at 77.93, off 115 points. You recall back in October, November, I spent a lot of time on this average. Remember, the Dow Jones Transportation Average is compiled of a bunch of companies, your biggest transportation companies in the world. The rails, the trucks, the shipping, the airlines, and you would think that with the price of gas as low as it is, that they would benefit. Well, the airlines have, the trucking has, but the world economy hasn't really kept in step with the price of gas. So you can have gas as cheap as you want, but if you have nobody to ship their products to, it doesn't matter. That average was breaking down, I mentioned, back in October and November of last year when it was at 9,200. And now here we are at almost in bear market territory, which would be a 20% decline. It's down around 15% since that 9,200 level in October of 2014. And the flight to quality, with all the selling going on in the equities, didn't carry over into the utilities average like it normally does. The Dow Jones Utility Average finished the week off 31 points at 541. The 10-year Treasury note sits at 2.13%. It was 2.18% from last Friday. And I'm going to talk more about that in just a few minutes. There's something there that I know you need to know, why that only moved very little. Anyway, that's the week in review, and as always, it's brought to you by our good friends at Minuteman Press. Give them a call, 772-567-4645, or visit them at 494 5th Street Southwest in Vero Beach for all your printing, shredding, and promotional item needs. I mentioned almost on a weekly basis that when the stock markets around the world sell off, there's always a safe haven in which to park those funds. Normally, those safe haven places are U.S. Treasuries and utility stocks. Well, predominantly, it's U.S. Treasuries, as I mentioned this week. The utilities they struggled. They actually followed suit with the regular stock market, the general direction of the market. So it was U.S. Treasuries was the place to be. But I would have expected, amidst all the recent turmoil in stock markets around the globe, that the yield on the U.S. Treasury note would be somewhere in the neighborhood of 1.8%. Instead, we are still looking at the nation's borrowing costs at over 2% on the 10-year note. What's going on? I'll tell you. Over the last couple of years, I have been an extreme optimist, and correct, I might add, that rates were heading lower. And this also put me in the minority of most economists' forecasts. My view back then, a little over a year ago, was stemmed from the fact, I should say, that I didn't see any signs of strength that would put pressure on prices, keeping inflation in check, not threatening interest rates in any way, up or down. So the question was asked of me, what would it take to change my view? In other words, what would have to happen for me to believe interest rates could climb? And that's an excellent question, and it's a question you should ask yourself, because many of you, no matter what you're investing in, it could be real estate, it could be stocks and bonds, before you make the investment and you accumulate the reasons why you're ready to make the purchase, ask yourself the question, what would change your mind to that decision, and have that, write that down, because it's very important, because things can happen in the world that would make you make a different, but cause you to choose otherwise. So it's always important to ask yourself, okay, here's what I like. What would change my mind a year down the road, 2 years down the road, 5 years down the road? What would change my mind 3 months later if something were to happen to cause me to do something else? It's very important that you figure that into the equation. Well, anyway, that was a question that was asked of me. And you see, for me, I knew the answer. So it wasn't really that tough of a question. And in fact, it didn't take me long to come up with the answer. And the answer was rather simple. It's China. Let me explain. China currently holds $1.27 trillion of our treasuries. That's T as in Tom. Trillion. Japan, they're just short of $1 trillion in the ownership of our treasuries. Let's just say it's the cost that we bear here in the United States for living beyond our means. We currently are an economy of $18 trillion or so. That takes in roughly $17.5 trillion. You don't need algebra to figure that we are in a budget deficit mode to the tune of some $500 billion. Now, don't get me wrong. The country can more than handle this deficit for quite some time, actually. A little tweaking in the fiscal policy after we get some people in Washington that actually have a clue about economics. So pay attention to who you vote for. But here's the problem that I have. The formula of budget deficit living, while we can last for that, we can live on that for a while, it only works so long as China continues to motor along its merry way and finds our treasury bonds attractive enough for investment. On the other hand, if China's economy stumbles and they're forced to raise cash to pump things up in their own economy, we've got problems. Serious ones, potentially, because they would now begin selling those very same treasuries we've depended on them buying for so long. That is exactly what is transpiring currently in the markets. It's what's happening. Over the past couple of weeks, as the world begins to wrap their brains around a weakening Chinese economy and how it affects them, China is dipping in their portfolio of U.S. Treasuries to stem the tide of outflowing capital. Now, we're not going to see wholesale selling on their part simply because it would be detrimental to their own cause. When you own $1.27 trillion of an asset, you don't just dump it all on the street. You're not going to get the desired price. You do it over time. See, that's the problem. They will do it over time because I don't think they understand the severity of their economy right now, the potential drawbacks to a slowdown. They're going to have to do something, and they may not react in a, well, shall we say, a sane manner. Okay, like I said, nothing. They're not going to dump it all at one time. But I assure you of this. It's the reason why the yield on the 10-year note is not somewhere down around 1.7, 1.8%. Investors, they've been running into the safety of treasuries, for sure. But there's more supply than there was just 2 or 3 months ago, keeping rates stable for now. Not bringing the rates down like you thought, like I thought they should have been. We should have rates right now somewhere in the, like I said, even 1.5%. But what happened, and it's not front page material on most of your newspapers, but I can tell you, they are beginning, I think, to the tune of some $58 billion. So what had happened in the last couple of weeks, while there was a flight to safety, meaning there were investors buying treasuries for that safe haven play, and that was happening. Rates were coming down, but it was met with supply. China was selling them their bonds. And that troubles me. That is why we are seeing it has a long way to go as to explaining the market's volatility. Now, here's what concerns me is right now, when they sell, they're meeting enough buyers. What happens when there's not enough buyers in the market to absorb their bonds? We will see an increase in interest rates. And this is the very issue that concerns me, and it's certainly changing my mind toward the direction of interest rates. Okay, so what do you do in this environment?